Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Alright, hi guys, welcome back to the channel. This is the Greedy Trader channel, where we learn about all things trading, market profile, liquidity, volume, time. For those of you guys who are new to the channel, welcome aboard. I know that so many of you have been stuck in a rabbit hole trying to work out this trading game, and it is not easy. You know, I've been doing this for more than 15 years. The reality of it is that I'm very good at it. I do very well with it, and I cut it and I explain to traders. I shouldn't say cut a pathway, but I explain to traders that you have to come at this in a specific way, right? And today, in this particular video, I'm going to show you a couple of things that is going to immediately transform the way that you trade and the way that you do things. In fact, I'm making a very bold claim now that if you follow exactly what I show you to do on this video, the chances you're going to become profitable almost immediately is going to be very, very high. I think a lot of people are stuck in rabbit holes because the trading space, especially the forex space, which is why I always advise traders to not start trading with forex, start with something else, because what you're going to find is the noise tends to be less in other things. So for example, what do I mean by other things? You know, start trading stocks, for example, or you know, if you, I mean, even futures. I'll leave futures for last because commodities are actually quite difficult to trade. You need to have also a good fundamental understanding of the landscape. So for example, if you trade crude, you need to know quite a bit about crude itself. You know, what's light sweet, what's medium sour, what countries use that, what's the transportation industry like around crude, understand the refining capacity of different countries, how that could potentially impact the demand for crude, start to understand inventory levels. So I think commodities are not really for beginners, and they tend to be more specialist markets, which is why you don't see a lot of people talking about pork belly trades online, right? Or you don't see a lot of people talking about trading soybeans, right? It's because they're specialist markets and most people are just scared and like, what the hell do I know about soybeans? Truth be told, these are difficult markets, but yet I see so many traders coming into trading and starting with futures, maybe because some online prop firm offers them like some capital that they could trade if they pass this challenge and that challenge, so they obviously get sucked into the web of trading commodities before they're ready. Whilst you know, if you start with stock markets, in my opinion anyway, it's a fairly simple, straightforward stock market. What your main focus will be to understand the demand and supply imbalance in the stock that you're trading. You can also trade stocks on smaller time frames because the way stocks tick, or rather the way the bid-ask quoting works, is very different from how it works in currencies, for example. So, and then I think if you can get a very good handle on stocks, and when I say stocks, start with blue chips, right? Blue chips have a lot of liquidity. You don't have to worry yourself about thinking about things like, you know, whether this is what the short float is like, for example, or you don't have to think about the overall float itself, so liquidity. Yeah, it's a little bit easier to start with blue chips, and if you're really good at blue chips, you can definitely find an edge in small caps or micro caps, for example. You know, small caps have really good momentum. A lot of small caps are companies that are not particularly doing well, so there's a lot of edge on the short side. So as you start to push away from the stuff that most people out on the internet, most marketers think is simple, that you probably are not going to lead a lot of tuition for, then you start to get a lot of noise, right? So you start to hear a lot of people, you know, talking about stuff, and that is just not healthy. You know, that's where the Lamborghini stuff comes in, and you know, the Ferrari stuff. It comes in those areas. And what are the target industries that people use for that? It's forex. Forex is like the number one. So if you say to someone, you know, you're walking down the road and you say I'm a trader, everyone's like, oh, so you trade Forex? You're like, oh my God. But that's today what people think about as traders, is that you're Forex traders, you know, and people say, oh yeah, I trade in a prop firm and I pass all these challenges or whatever. And basically what they're saying is that I'm a Forex trader, right? But if you know, if I recall like 20 years ago, if you said to someone you're a trader, they think, well, you know, you probably work at a bank or you trade the stock market. They don't think about Forex, but now they do. So Forex has become popular, and why is that?
Reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
What?
It's gone. It's all gone.
What's all gone?
The money in your account. It didn't do too well. It's gone.
What do you mean? I have $100.
It's because of marketers, right? So my advice to any new trader is stay away from the stuff that's full of marketers in there. People are going to crucify me for saying this because I'm ruining their business models. But if you stay away from that in the beginning, you're going to filter out the noise and you're going to be able to learn robust things. But anyway, I'm going to cut the initial conversation here right now. I didn't want to make the video entirely about some of the bad stuff or the rabbit hole, but it makes sense to kind of make it clear that when you come to this channel, this is not what you're going to find here. You're going to find a lot of education. You're going to learn a lot. I'm pretty sure you're going to be profitable if you stick around. If you don't, then, you know, I presume you've chosen to follow the right rabbit.
This is your last chance.
Wherever that leads. In any case, back to the video. So what are we talking about today, right? So for those of you guys who know my core method around trading, I have 3 core tenets, all right? So think about it as my own trifecta, right? So these are 3 core tenets that I focus on. So my trading trifecta is liquidity, volume, and time, right? And I'm going to show you each one, right? And I think of all these ideas as models, right? So I'm going to show you each one. So liquidity, volume, and time. So the volume part of it is what deals with everything to do with the demand and supply of whatever I trade. So I want to understand this very well. So when I say demand and supply, I want to know where the buyers are strong, where the sellers are strong, right? That gives me a good sense of demand and supply picture, which in a way is a picture of liquidity as well. But I'm more interested in the actual liquidity that is coming to market on the book. My next part of my trifecta is liquidity. Now, the market is always going to find areas of strong liquidity. And in today's market, when we say, especially in margined markets, liquidity is generally found at extremes, right? So where the stop losses are going to be. So my next job is to identify where the key stops are, and that becomes my liquidity model. If we can trade and trigger those stops, then that gives me an amazing trading opportunity. So we've covered demand and supply, we've covered liquidity. Now there's something else that people don't often talk about, and that is time. So it doesn't make sense trading at times where the demand and supply is going to be weak and the liquidity is going to be weak. So my focus is major center opens. So London Open, the US Open, but particularly the US Open because that's where we get the strongest liquidity. Now the US has 3 center opens. They have New York, they have Chicago, and essentially, well, arguably the NASDAQ Open, right? So you've got New York, NASDAQ, and Chicago. These are very pivotal sessions because the NASDAQ Open at 2:30 is when all the major stocks that people like to trade, all the blue chips, they come online. The New York Open is important because that's when the New York Stock Exchange comes online, as well as all the US data associated with things like inflation, non-farm payroll, anything that could potentially move the market. So all the labor stats, everything comes out between sort of 1 and 1:30. Chicago is important because that's where all the major commodity exchanges are, and because a lot of exchange has to happen between dollars and commodities. If you're going to buy a commodity or sell a commodity, it means that Chicago is going to be pivotal. That's where all the derivatives are, the futures, for example. The options are more associated with the NASDAQ, why that session is also pivotal. So the time is an important aspect. So my focus is the US because that's where you're going to get the real market moving information. London is incredibly difficult to trade because we are missing a core part of market information. London acts more like an after hours session for the US or somewhat of a pre-market depending on how you look at it. So London could, depending on the asset, London could be very informative, but I find many times it's just development. And we'll see that in what I'm going to show you today in this video. Okay, cool. So I'm hoping at this point you get my core idea of how I like to trade. Now this won't change. It doesn't alter. Any other tool that I have is to enhance this. And this is one of the big mistakes that traders make as well, is that they want to kind of focus on doing all these multiple strategies. They want to trade these multiple assets. And it doesn't really work, especially if you're new. You just don't have the bandwidth to take on all this information and make really good trades. So I would often suggest to traders is that you want to focus on one single time frame. I say one single time frame. You want to focus on one single asset, and to a degree as well, you want to have a preferred trading time frame. But we're going to come to that and you're going to see mine. If I'm trading cable, which is my preferred asset, so if I'm in the FX market, I'm looking primarily at cable. Rarely going to look at anything else. As you can tell from my accent, you know, I'm British.
Are you actually saying that?
And my focus will always be cable, right? So I'm not necessarily, you know, focused on any other asset because generally speaking, I don't really understand it. And if you're in a professional environment, you will be covering a desk, and that desk will be associated with a specific currency. So if you're in an FX FX swap desk, for example, that would have been your focus. It would have been one individual currency, right? So bottom line is that there's no reason for you to be focusing on multiple things. Master one thing, get really good at it, find your edge, and you're going to be successful. Okay, moving on. So let's talk a little bit about what we're seeing currently, right? So this session is largely going to be about current price action, so everyone can get the idea of how things are being perceived. And also remember, I'm recording this video on Fed Day, right? So today we have the Federal Reserve interest rate meeting, so there's going to be a lot of market movement later in the day. I do not expect to see a lot of big demand and supply picture in the Nasdaq, in any other market open, but I do expect to see a hell of a lot of volume coming in, and that will be more than likely around about sort of 6-7 o'clock when we do get the Fed interest rate decision. Let's not get bogged down into what the Fed is going to do. I think well, if you have any understanding of what's going on right now, it makes sense that we will not get a rate cut. We might get a rate cut in December, which is my position. And if we do get a rate cut in December, most of that information will be front run into the stock market. So if the Fed is to signal in this meeting that this is still on the table, it's very possible we're going to get a big market rally in stocks and we're going to see everything going to the moon. Or it could be completely the opposite. Everything could go to the floor, but let's not concern ourselves with that. This is completely irrelevant. We first need to be able to see what the players do at the end of the meeting before we can decide whether we want to participate in this market or not. So we don't want to try and preempt anything because really and truly, no one can know what the market is going to do. But what we do know is what central bankers are going to do and the long-term effect of that. So we know in the future the dollar is going to go down more than likely because the Fed is going to print money at some point. But let's not get caught up with whether it's going to be today, tomorrow, whenever. Right, arguably some people will say the Fed is still printing. You know, you just have to look at the reserve repo facility, but we're not going to get into that. Right, so let's focus now on what's been going on over the past 2 days, and so you start to give us some ideas of how we could have traded this or what we are likely to see happen in the future. Now I'm going to start with the first concept, which is liquidity. Right, so if you take a look at my screen now, I want you to ignore all these these rectangles and just focus on the candlesticks, right? Price action. So as you can see, at 3 a.m., which is normally when we get all the settlement in the settlement on the FX decks, that's 3 a.m., right? So you can see that we get 3 a.m. London, we get a huge volume trade in, very unusual for Asia, and then the market walks low. But we'll talk about volume very shortly. And then the market drops, and by the time we get to London, 9 a.m., we are pretty much trading what I would describe as a liquidity area, right? And why is it a liquidity area? I've spoken about this before. I've got other videos on this, but it's a liquidity area because likely they're going to be stops at these lows. Either these are going to be sell stops to trigger the market to the downside, i.e. pending order sell stops, or they're going to be stop losses or sell stop losses for people who are trying to get long, right? So this area is going to be an area of interest. As soon as we trade lower and trigger those stops, the market is likely to go higher. And this is what we talk about when we say liquidity, because if we're triggering sell stops are selling to buyers, right? Because they're sell orders to sell to someone else. And if the buyers are able to take collect all that inventory at these low prices, then their objective is to sell them at higher prices. So as the market goes lower and hits bids, essentially what we're doing here is we're seeing big market makers buying at the bid and being able to sell at the offer, right? And that's what's going on. So if you think about this on a large scale, where the market is tanking and large entities want in, they're going to be prepared to buy at these very cheap prices where most retail investors are happy to sell, right? And this is going to occur on multiple time frames, but I like to focus on the 1 hour time frame. But that's the liquidity model. So this immediately tells us that there was a very high chance that if we were to start to offer up, that this market was going to have a rally. Now this brings me to the next part of my trading model, which is volume, right? So what I'm looking for now, I can see that based on my liquidity model, there's an opportunity to go long. But I also know that we're not going to be able to break the supply most likely that occurred at 7 a.m. And there's a good reason for that, because one, I say 7 a.m., 3 a.m. The 3 a.m. volume, which you can see here, is the highest volume pretty much of the entire session so far, which means that the sellers here are really strong. This market is a little overextended into liquidity, so a reversal was inevitable. Right, whilst I could not have predicted that we're going to go back into the supply area, I was certainly sure that there was going to be a reversal here at this point. So this becomes a really good opportunity in terms of risk reward, in terms of trade location. There are a lot of reasons why this trade is a higher probability trade. But what else should we have to bear in mind? Now, if we bring our next model into play, that's volume, we can see that there is no volume trading at the lowest prices of the day so far, and it's pretty low relative to prior volume. So that tells us that there's no greater demand sitting here, to be honest. What we might see is a profit take or short covering, but there's no greater demand. It could even be market manipulation, right? The truth is that we know there's a liquidity low here. There's a high chance of a reversal. If we're getting into a trade like this, we're going to have to risk manage this very carefully. We know there's a higher chance that the market could come and test the lows. So it's actually a very high risk trade. But we've seen that the market's closed higher, so it makes sense at this point for us to maybe consider a long, right? At this point, right, at the close of that bar, or maybe look for us to dip back in again. But if we don't get that, then more than likely we're going to miss this trade. But let's make the assumption that we didn't miss the trade, that you got long, right? And you put your stops below the low, right? This makes sense. And then you're looking to trade this potentially into where the supply was at 3 a.m. in Asia. That will be a really good strategy. The reason for that is that one, you're trading at 10 a.m. You're trading into a US session, right? So you should be able to liquidate your trade in the US session if you suspect that that session is going to bring additional information. So getting long at 10 a.m. is a really good opportunity to see where this market goes by the time we get to the US Open, right? In fact, by 1 p.m., we can clearly see that the volume was still quite low on the supply side. It wasn't even the highest price of the day, and we can see even with the highest price of the day, whilst there was some supply there, reasonably speaking, it wasn't higher than what we saw in Asia. So for me, this is a sign that we're more than likely going to get higher prices till we can actually bring that supply back into play, like real supply, right? Now, so far across this day, we haven't actually seen any real supply. What we've seen is the market most likely covering going into the supply area from Asia. Right, so this is telling me that, well, if we start to fail in Asia, then it means that the short is going to reestablish itself. You might not want to hold an overnight trade. That might give you a little bit more risk than you require. So you might want to stay out of overnight trades, but this would have been a good trading opportunity. And certainly there wouldn't have been any trading opportunities in the US session simply because there was no volume. Right? When I say there was no volume, it doesn't mean that there wasn't volume trading. Of course there is, we can see that. But what I'm saying is that there was no volume to overcome the volume that was traded in at 3 a.m., which is highly unusual. The Asian session, it tends to be the weakest. So if traders are trading short on that session and still holding it as a big session, it means that the dominant position is sellers, right? So sellers are holding the dominant position. They're not only holding the dominant position, they're holding it in a very, very illiquid session. And that's interesting information. I'm sure lots of you would agree. Okay, so rewind. That's the volume model. Right, now let's look at what's currently taking place to reinforce the idea of the volume model. We can see at 7 a.m. in London, so it's not quite the London Open. I think of 8 a.m. as the London Open, but 7 a.m. is sort of pre-London Open. We can see that there's an awful lot of volume trading here. We've got two sides, somewhat acting like demand, somewhat acting like supply. It has been confirmed as supply because price continued to trade lower. Now, if we look at the lowest price of the day, we hardly have any volume here. So this is technically a very weak buyer's market. I'm not expecting a rally. I would suspect that prices will continue lower into potentially, again, what would be a liquidity area, which is round about here, right? So the expectation should be we should clear liquidity. And if we're going to get a rally, it should come from these lows. So do we want to be trading long now? Absolutely not. You can't see any demand here. So what is the point? In fact, sellers have the day. So if we can't entice any reasonable demand at the liquidity area, then we're likely going to trade back in the supply and then we're going to fall back out again. This is an incredibly weak market. It is genuinely at this point favoring sellers. But we also know that if we think of the volume relative to the 3 a.m. volume, we know that these sellers are still very dominant so far, even into today. And that tells you that there's something really wrong. And usually you tend to see this when we've got a major news event coming because most people don't want to tip their hand. So at this point in time, I think all of the volume is waiting for the Fed. Once that happens, we could see a break to the upside, in which case these sellers will have to cover their short. And we're going to get a mass liquidation event and sterling would likely move higher. Now, if we continue lower into the Fed, then again, we could trigger liquidity, get a mass buying event, and then sterling could go higher. At the moment, there's no argument to say, well, if we go here, sterling continues lower. We don't know. So we'll have to see what happens when the Fed opens. But for now, you can clearly see that because of the way we've set up, this is a non-trading opportunity. Now, some people argue with me and say, well, yeah, but if I'd shorted, I would have made some money. But that's not how trading works. And that's why you probably lose money more than you make. Because in the end of the day, you should only trade on clear opportunities, things that you can see and quantify based on your own technical strategy. Of course, because of my TRIFECTA method, I need to see us trading either a strong liquidity area, which will interest me, or I need to see that supported by demand. Now, if both things could occur, for example, here we traded above a liquidity area and failed, that's a liquidity model supported by a supply and demand model, right? Then now I'll be more interested in shorting this market because obviously I can see that this fits in with my trading model. Whilst here I can clearly see, well, there was a liquidity model triggering, but I can't see any demand model supporting it. So I might not be very interested in taking the long side, even though we had a really big move. But I would have still profited from the short side. Maybe not as much as if I'd got the absolute low tick on the long side. But hey, by trading like this, I'm protecting myself from unnecessary losses, big losses that I'm unprepared for. And I'm also not so sucked in by the psychology of the market, right? So I don't really have that herd mentality. I'm just waiting to see whether my models are going to come into play. Now for my very last model, which is my time model, I refrain from trading at times that in my opinion are not going to bring in a lot of liquidity. For example, I might be happy to trade in the London Open or in and around it, right? So when I say in and around it, 7, 8, 9, 10, 11, not really a good idea for me. So a trade like this wouldn't really be as interesting to me. On the flip side, We came into 6 p.m. and we are approaching the FTSE close, and this is very late. A 6 p.m. trade also might not be appealing to me. But on the flip side, if we can retest this level, short trade in London might be more appealing to me. So as you can see, even though there have been a lot of opportunities, I'm focusing on opportunities that come out of major sessions as opposed to ones that are not major. So in this case, for example, 9 a.m. Would have been a really interesting session if I was interested in taking the liquidity model trade. So on the pullback, I might have said, okay, I'm going to go off the back that this is a London open, but I certainly won't be trading at 12 noon or 11 o'clock or say, for example, 5 o'clock. However, if there was an opportunity at between 2 p.m. and 3 p.m., that is the Chicago Open and the Nasdaq Open. I'd be more interested in that as opposed to anything else. So on this day, it was highly volatile. It really didn't give you much information. Any trades that were successful were highly based on luck as opposed to skill. And this is something we need to factor in. Again, if I was trading the demand and supply model solely and there was a huge move like this in 3 a.m., then I might have anticipated we would get a very deep sell-off in the London session. And that's because this is an Asia session, but it's also a settlement time for cash settlements in the interbank market. So it might have been of interest to me for that reason. But I live in London, so I'm not awake to trade this session. So this is a non-starter. So there are other methods you could apply or other ideas to take trades, but these for me are the most reliable ideas that will often keep you out of trades that could get you into trouble and keep you in trades that are going to make you more successful. Again, guys, hope you enjoyed the video. I make a lot of these to teach people how to do this and do this effectively. Till my next video, guys. Adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?